Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zacks Director of ETF Research, Neena Mishra, to talk about gold. Yes, it's one of our favorite topics. I know you all hate it, but maybe you don't anymore, or maybe it's a love-hate relationship with it, because gold is still breaking out to new all-time highs. In fact, it just recently did here in August of 2025, kind of on a technicality as the market was concerned about a possible tariff on gold bars coming into the United States, but that has been squelched now. So gold prices have pulled back off of highs just over $3,500 an ounce, but it's been holding above $3,000 an ounce for the last 4 to 5 months now. It held those levels for the second quarter, and now we're in the third quarter, and this means good things for the miners. Their all-in prices are about half or less than half of what they're getting when they get it out of the ground at these prices. So what is going on with the gold miners? What's going on with the ETFs? Where should you be? Maybe all of it. I don't know, but I brought Neena on board this week to talk about it all. So welcome to the podcast, Neena.
Hi, Tracey. Thanks for having me on. It's always fun to talk about gold, right? So as you mentioned, gold has been doing very well. And of course, all this uncertainty regarding tariffs and trade barriers and all that. And plus, a major factor has been central bank buying that we know. And central banks all over the world, they have been buying a lot of gold, particularly since Russia invaded Ukraine. And lately, there have been so many concerns about rising fiscal deterioration in the US. So that is another reason why they want to diversify a little bit out of the US dollar and add gold to their reserves. In fact, the World Gold Council reported recently that gold has now become the second most popular reserve asset, overtaking the euro. So a lot of weight to the US dollars in these official reserves. And number two is gold. And central banks continued their purchases during the second quarter as well. But the prices, they were kind of in a holding pattern during the second quarter, because after we saw a little bit more clarity on the tariff situation, investors started piling back into stocks, particularly the Max 7 stocks. So those ETFs saw huge inflows. But I was surprised to see that gold prices have held quite well, even when investors were in, a full risk on sentiment. We have seen decent inflows into gold ETFs. But what is surprising, that gold mining ETFs, and we know that gold miners are leverage plays on the price of the bullion. So gold miners have done so well this year. But despite that excellent performance, gold mining ETFs have seen outflows this year, which kind of surprised me. The most popular gold mining ETF, which is GDX by Ryniec, that is down in terms of assets. It's down 3.5 billion, outflows of 3.5 billion year to date. So investors are just not buying these gold miners ETFs. Gold ETFs, they are buying a little bit. So we have seen decent inflows, nowhere close to the levels of inflows into Bitcoin or Ether ETFs, but even then, gold ETFs like popular gold ETFs like GLD and GLDM, they have seen decent inflows, but no love for gold mining ETFs, which has been surprising.
Yeah, we've talked about this off of the podcast, because I'm assuming with these kinds of returns, and it has been one of the best industries this year, that, people would start piling in. They would have fear of missing out, and they're like, hey, there's something's going on with that and I need to get in there. But instead they're doing the opposite. But that to me is very bullish for the gold miners because I don't really want a mania at this point in it. That usually comes later. And so the fact that people are still being cautious or they really just don't believe that gold is going to hold at these levels. And rightly so, they've had, 20 years of ups and downs. The last big bull run in gold was like 2006 into 2010. And so that's a whole generation ago. And a lot of people, we have short memories anyway, so we're not even thinking back to that. And so a lot of people have been burned and they think maybe the run is over. It has had a big rally this year. So why get into it? And so they're not. But the fundamentals are the strongest I have seen. And I have been watching gold since about 2006. And I can't believe some of these earnings reports from this last quarter. But for it, let's just say I want to buck the trends and I do want to buy the gold miners. Even though they're breaking out, I saw when gold was hitting another set of new highs, the GDX was hitting it as well. But is that where I need to go? I always just default to the GDX because it was like the original gold mining ETF. But I know that there's a few more options now. And, like, how do they differ? Why would I want to be in something else other than the GDX? Or does it matter?
Yeah, so let me share my screen and talk about some of these mining ETFs. So you can go to the quote page on Zacks.com, and GDX by Ryniec, as you mentioned, it's the oldest and also the largest gold mining ETF, and it has an expense ratio of 51 basis points. Now you can use the link to go to Ryniec's webpage. Ryniec has good research on their website. This is up about 71% eye-popping performance. And it has about 17 billion in assets under management. Now you can look at the holdings also. So all these, there are other two ETFs also, which I'm going to talk about. You will see very similar holdings, but the weights are going to differ in the portfolio. So in this portfolio, you see that the top two, Newmont and Agnico, they are about 26% of the portfolio. And if you want to look at GDX, you should also remember that Ryniec has announced that their benchmark index is going to change in September. And on their website, they also have this document, what to know about the index change. And you can also see how the weights of some of those holdings is going to change after September index change. So Newmont's weight is going to come down a little bit. Agnico's wouldn't change a lot. Then Wheaton also, is going to come down a little bit. So this is something which you should remember if you are looking at GDX. Now, there are a couple other options for investors, which investors can look at, and we can talk about the differences too. So Sprott has one gold miners ETF, and this
And what is the
focuses
ticker
on
on the Sprott?
SGDM. And Sprott also, it's a Canadian company, and they have some ETFs listed in the US, and they have good research on their website. So you can read their research. So Sprott is slightly smaller, 456 million in assets, similar expense ratio. If you look at the holdings, this focuses on the largest gold miners. So you will see that the portfolio is a little bit more concentrated, or probably it's about the same, not exactly more concentrated. But the one which has a very concentrated portfolio is by iShares, and this is also the cheapest in this space. This has an expense ratio of 39 basis points, and this is up more than 76% year to date. The ticker symbol is RING, easy to remember. And if you look at the holdings, you will see this has the most concentrated portfolio. So almost 29% in the top two holdings, Newmont and Agnico. So apart from that, you will see that they have similar, gold miners. You can look at the weights, which is going to differ in the three options, and that is going to result in slight differences in the performance of these ETFs.
Yeah, it's always good to consider the expense ratios, of course. Um, and also something people should keep in mind on those lists of what the holdings were. Wheaton kept coming up as like the third largest on those, and that's a silver miner. So there are going to be silver miners in there because there just aren't enough.
Yeah,
And there's
gold
been a
miners, pure
lot.
play gold mines. Yeah.
Yeah,
Mhm.
there's been a lot of
Mhm.
consolidation in the industry since I first started watching in 2005, 2006. You still do have the big guys like Newmont's up at the top, but a lot of the others have been bought out. And so that limits the number that you can have in there too. So you are getting a combination, but silver's also in a big rally and is at extremely high price right now too. So the underlying fundamentals are the same. And some of the gold miners also will be mining silver or copper, and copper prices are elevated as well. So it's kind of the best of all worlds if you're interested in any of those three metals, but especially gold, obviously. So yeah, it was kind of shocking to tune into some of these earnings reports for the gold miners, and I tuned into a couple for the silver. But I know that they are being cautious here because this was just one quarter. It was just one quarter above 3,000 that they were able to capture. So it was great. Many of them had record free cash flows for the quarter. They have a lot of cash on hand sitting there. I think we're still really early in the cycle and we're not going to get the bigger dividend payouts yet. But if this continues above 3,000, we will start to see enhanced dividends. And I'm going to talk about that in a second. But right now, they are paying down debt, which is important for these companies because this is their chance. You know, these are heavily, there's a lot of debt that goes into mining. And I always remind people as well that it's all about getting it out of the ground, but there are issues with getting it out of the ground. It's just simply not that easy. We just had we just had a mining tragedy down in South America, and so you have a lot of things that you're juggling if you are a mining company. And some of that is also, as we've talked about, the geopolitical issues too. Where are the companies mining? So that's something to look at if you're going to buy the individual miners, because are they mining in the US? Are they in Canada? Are they in Australia? South Africa is another big mining location. But it depends on where you are, what's happening with the government there. And as the price rises, things may change in certain locations because it's going to get just a little too lucrative, little too much money sloshing around. And some governments might want a bigger cut of what's happening there. So, do you have any advice on, I feel like for most people, if they don't own any miners, that maybe they should just buy one of the ETFs because you are getting the big ones in that big position, over 20% in all of those ETFs. And then if something does happen at one of them, it's not going to matter that much for the overall impact of the ETF versus, trying to pick and choose individual names.
Yeah. So as we were talking about Barrick just before the call, so Barrick had some of their, operations suspended in Mali, and also the military junta there imposed some fines and all that. So that is something investors should be aware of. These companies have a lot of international exposure, including in countries which may have, geopolitical and other issues. So as you mentioned, I think a diversified exposure using ETFs makes a lot of sense instead of, just trying to pick and choose one particular company. For investors who were invested in Barrick, they were probably not happy when all that was reported. So yes, I believe that ETF is a, better way to go. But if you're tracking your portfolio very, very closely, then maybe you can look at some of the ETFs, sorry, some of the individual miners as well, which I believe you're going to talk about.
Yeah, let's look at Barrick. I'm going to share my screen now. And since we were just talking about Barrick, and it is the most recent one to report earnings, it's ticker B, and they are Canadian, but they're one of the big guys. And they did have, as you mentioned, some issues. Again, I always just call it getting it out of the ground, but they still had a very excellent quarter. Just showing the price consensus and surprise chart here, they did beat, but just free cash flow of 770 million just in that quarter. It was up 107% year over year. They do have some copper mining as well. They repurchased a bunch of shares, so that's what they're doing with a lot of the money. Almost all of the miners I've seen have some kind of share repurchase going on. This was 268 million in the quarter. They were paying a dividend, and a lot of these companies are paying just kind of like a base dividend, and you can see that over here, 40 cents. So 10 cents a quarter is what they were paying, but they did announce this quarter that they're doing this enhanced dividend. It was 5 cents extra. So it's 15 cents for this quarter. And I think you're going to see a lot more of the miners doing this if the price holds above 3,000, into the end of the year. So every quarter that goes on, they don't have to do anything with the base. They know they can cover that. And then they will maybe do a little bit of enhancement. They're already doing big share buybacks. They're going to pay down some debt. But the longer it goes on, the more of this cash is just kind of going to be floating around. And so they will just do these variables, similar to what the oil companies did when the Ukraine war started and they had the huge free cash flows. They mostly just kept their regular base dividend, and then they added these enhancements. Now, some of them are starting to do what some of the oil companies did back then, and that is to do something like, we're going to pay out 50% of our free cash flow. But I've only seen one miner doing that kind of program so far, and because it's still kind of early. So again, even the miners, they've been burned too over the last 20 years, and they don't totally trust that it's going to stay at these levels. But once you get a couple of quarters at this level, if we do, then that's when they'll start putting those kinds of programs into place of, it doesn't matter how much we're taking in, we're going to give you 50 or 60% of it. And then the rest is going to go to, buy some more mines, build outs, or those kinds of things. That's also something to keep in mind too, that if you get a miner that is in the midst of actually opening a mine, or, they're always looking, they're always exploring, it costs a lot of money. It costs a lot of money to go in to even see what is there in the mine, and then to get to the first pour at the mine, and then to get to commercial production takes several years, a lot of money. You're paying it up front, and then hopefully the gold prices stay high enough that you're going to get it back once that mine is producing. That's why we probably will see some more consolidation in the industry. Some of the junior gold miners are just going to be snatched up by the big guys who don't want to, they just want an operating mine. They don't want to deal with getting one up to speed. So they'll just go out there and purchase some of these smaller miners too. We've seen some of that already in the second quarter and a little bit into this third quarter. So I do think we're going to see more. One other thing about like Barrick, you can see that the earnings estimates are just soaring up here because gold has stayed elevated. But because we've got the rising earnings, and I'm showing the sales and EPS growth rate chart, now you can see 55% earnings growth for this year now expected. And then they are starting to look forward. And this is pretty bullish, 24% for 2026, because it is still a little early to know what the prices are going to be over there. But we do have cheapness on the PE because of the surge in earnings, even with the shares rallying, and we've got the cheap pegs. So these are kind of interesting value stocks here, but it is always cyclical with these. But I do think we're in the earlier phases. So Barrick has had a little more issues than some of the others. And you can see on this chart, it's not anywhere near its 2020 highs, not even close. So if you're kind of a contrarian, you're thinking, hey, maybe it might get back to that. So maybe I do want to be in something like a Barrick that has had a few more difficulties than some of the others. I know one of the most popular ones is Agnico Eagle. I know you've been talking about this one too, Neena. Everybody is, just because it has one of the best charts. Also still a Zacks number one, and I'm bringing it up because it keeps breaking out to new all-time highs here. And it looks kind of messy because you got all these beats in a row, and then you just have this big gain on the earnings there. And they had, they're paying down debt too. They had record free cash flows, and I have that it was 1.3 billion in that quarter. And so dividend is down here yielding 1.2. I think they're doing a buyback too. I'm sure they are. I didn't write it down, but I'm pretty sure they are. And I have that they have net cash position in the second quarter of 963 million. And it had been negative just recently. But this is what happens when you get record.
Yeah, the second quarter was really impressive.
Yeah. And you have to love it for the miners because, again, they've been waiting a long time. I mean, even look on this chart, just like years of kind of doing nothing, waiting for gold. Gold didn't really crash down. It was just kind of sitting there around the same levels, a couple $100 above what their all-in costs are. But now, as I mentioned, it's almost double their all-in costs, or more than double in some cases. And so that's a big factor with a lot of these miners. So if you're looking, they're all kind of in the same range, but some miners do have higher costs for a variety of reasons than others. So that's where it gets a little more difficult to pick and choose individually, unless you are some kind of gold mining expert. Harmony Gold is another one that I haven't looked at in a while. They are in South Africa. And they, in their recent earnings, they did confirm their annual production and their guidance, but they did say they had a challenging quarter due to weather and safety incidents. So again, it is about getting it out of the ground. And yes, something like weather, depending on where their mines are located, could play a factor in what they're able to get out. But they did confirm that annual production. So they actually are reporting, because they're South African, they're only reporting like every 6 months. So that's another thing you should be aware of with some of these companies. You might not get every quarter. And they are reporting at the end of August for the full year, August 28th. So something to keep in mind. But they've got the Zacks number one because, again, those estimates are on the rise. And look how cheap Harmony is here, though, 5.4 times on the PE. Look at the peg. I don't think I've ever seen a peg that low. Yeah. That's pretty crazy. But we just have this surge in earnings. The shares have rallied. They've come a little bit off those recent highs, though, because of some of these issues that they've been talking about the weather and the safety incidents and things. So Harmony, and it does pay a dividend, as you can see there. These are all similar dividend yields for now, but a lot of them are doing the share buybacks. And then I do think we're going to see more of these enhanced dividends because we have to. What else are they going to do with it? You know, and then, of course, let's just talk about Newmont because it was one of the biggest holdings in all those ETFs. So you are going to own it if you own any of those ETFs we've talked about. It is a number one. It is based in Colorado. That's why a lot of people like it because it's got, the American regulations on it, and they are going to report every quarter. So you're not going to have to wait every 6 months. It's had strong quarters too. Look at these big green arrows here on the beats. And then just like all these charts, the earnings got a nice big surge. They did raise their share buyback. They are keeping this dividend, which is $1. And so that's only similar yields, 1.5%. But they had huge free cash flows in their quarter as well, 1.7 billion. So they raised their share buyback plan to 3 billion for right now. So that's going to put a floor under the shares to some extent too, even though it is a big cap stock. But if you get any weakness there, I'm sure the company themselves will be coming in, stepping in to buy the shares with that kind of buyback. So that's something to keep in mind. But it too is not yet back to its prior 5-year highs here. So we got a little ways to go. That's again why I'm bullish, because all the fundamentals are here. Newmont trading at 13 times, but that peg is nice at 0.8. 51% earnings growth expected for this year. And then this is what I was kind of talking about 2026. This is showing a decline of just 0.2, but it is still pretty early and nobody really knows for sure what's going to be happening. On the chart, you can see it's just they're all just kind of hanging out there at high levels, but not a lot of growth yet because the growth is really going to come from the price of the underlying metals and how much they can get out of the ground. So that's something to watch with all of these. But it is kind of complicated to keep an eye on a bunch of these all at once. That's why I do like the ETFs in this situation. I own some individuals because I own some individuals in the value investor. But I used to own the miners way back in the day, but I sold out of there. I haven't gone back in, but now I don't know. I'm considering it again just to get exposure to everything, including the silver miners. But otherwise, I do think everybody should have a little bit of gold exposure here, and that this rally isn't over. What do you think, Neena?
I think this rally is going to continue in gold, and particularly as we talked about earlier, central banks are going to stay a major driving force. And also, we have some clarity on the tariff front, but there's still a lot of uncertainty. And stocks have done quite well, but I think once some more uncertainty emerges in the coming weeks, particularly economy has also shown some signs of weakness. So if we see some uncertainty on the economic front or geopolitical front or policy front, then investors are going to again pile back into gold and gold ETFs. And probably then they will notice the performance of these gold mining ETFs as well. And if they see some investor interest and see some decent inflows, that will not only benefit these ETFs as such, but that will benefit the gold mining companies also, because these top gold mining companies, they are the top holdings in these ETFs. So inflows will help those gold miners as well. So I totally recommend that investors should have some allocation to gold, mainly because of its diversification benefits over the past decade. So many decades, gold has acted as a good diversifier in an equity focused portfolio, and most of us have equity focused portfolios. So having some allocation to gold, maybe around 3 to 5%, makes a lot of sense, and maybe a little bit of exposure to gold miners too. And for most investors, maybe gold mining exposure via ETFs makes a lot of sense.
Yeah. And I have noticed for most of this rally, the gold mining ETFs have moved with the price of gold. So when gold hit new highs, the gold miner ETFs did as well. If gold was down on a day, the ETFs were down for the miners. But in recent weeks, the gold
Yeah,
miners have
second
kind of,
quarter.
yeah,
Yeah.
they've
Gold did
disconnected.
not do right. Gold did not do much during the second quarter, and as we discussed earlier, investors were in full risk on mode, but miners continued to rise. So that was pretty impressive, and probably that trend may continue.
Yeah, I feel like that's the next stage of the bull in gold for the miners is that they may disconnect from the actual underlying metal a bit because they're cheap. And so, they get those free cash flows and people think, hey, maybe I need to own that cash that they're generating. And so, yeah, there's a lot of bullish indicators to me, and the fact that not many people will listen to this podcast or watch our video, but maybe I'll be wrong. One of these days we will be wrong and we'll be surprised that people are interested, but that's a bullish indicator. It's very contrarian that we have, some of these ETFs up over 70% year to date, and still nobody's really paying any attention or caring very much that this is happening. So, very bullish to me. I like these contrarian plays, and the fundamentals are all there. And I love it when any company is starting to see records, record free cash flows and things, especially after struggling for a number of years. And so it's been fun to listen in on these conference calls, if I do say so. So check out some of them and see what's going on and try to get as much info as you can on some of these foreign miners. For the big foreign miners, there's pretty decent analyst coverage, I feel. You only get into troubles when you go to the more junior miners, and then there's a lot less coverage there. So, but these big ones that we've mentioned, it's, there is a lot of information out there. So have at it. And we will continue to cover these miners here because it is, other than AI, the big story of this year. And we aim to bring you as many of the hot stocks as possible. And the miners are in that category. Okay, let me recap the tickers we discussed. So if you want some of the ETFs, the oldest and largest is the GDX. I just call it G as in George, D as in David, X is the ticker there. Then we talked about the Sprout ETF. That's Canadian. S as in Sam, G as in George, D as in David, M as in Mary, SGDM. And then the ring, which is a little more concentrated and you get the smaller, cheaper expense ratio, is ring, RING. And then a few of the just standalone miners. We talked about Agnico Eagle. That's A as in Adam, E as in Edward, M as in Mary. We talked about Harmony, HMY. Oh, and one other thing about Harmony I forgot to mention. And I do think this is kind of relevant for them. They actually are hedging. We didn't talk about hedging because almost nobody is hedging because it's at record highs. And the hedge means you are buying a contract to hedge the price, to kind of protect yourself on the downside. So if there is a big sell-off, you don't take it on the chin as much. But when you get into these bull markets in oil, in metals, a lot of the companies go unhedged. They don't buy the contracts because they believe it's going to stay elevated. So why would you want to get a lower price on anything at this point? But they are hedging 10 to 30% of production over a rolling 36-month period. So keep that in mind as well if you're looking around. It's the only one I've seen so far that is hedging, but there may be others. So check on the hedging. So that's Harmony is hedging. HMY is the ticker for them. And then we talked about Newmont, N as in Nancy, E as in Edward, M as in Mary for Newmont, and Barrick. We started off with them. They're just B. They get the golden single digit ticker B. So that covers it pretty good for us here. Neena, any parting words about gold?
Yeah, own some gold and some miners too.
Yeah,
It's going to do good for your portfolio.
Yeah. So we'll be back as always next week. Make sure you subscribe. You can get our video podcast here on YouTube. Just go to zacks.com/YouTube or just put Zacks Investment Research into the search bar and you'll find us. Be sure to just subscribe there. You'll get all of our videos, including the top stock picks of the week, which probably will have some gold stocks on them soon. A lot of Zacks number one ranked strong buys in the gold miners, and that's what that video covers. So make sure you get us there. Get us on Apple for the audio podcast. Get us on Spotify. We're on Amazon Music. We're on SoundCloud. Just about anywhere you can get podcasts, you will find us. But make sure you get us somewhere. And I'll see you again next week with some more stocks.